My next guest is Michael Schumacher, Global Head of Macro Strategy at Wells Fargo Securities. He joins us along with CNBC Senior Economics Reporter Steve Leisman. Welcome to both of you. And Michael Schumacher, why is the 10-year backing up on the PPI report?
I think people are nervous, Kelly. You think about this amazing confluence of political events and also shifts in inflation. You've got CPI tomorrow, not just in the U.S., but also the U.K., as a matter of fact. Got the inauguration just a few days away. It's a lot to take in, so I think there's a bit of risk aversion.
And that being said, does that tell you that, you had said there's a risk that the market is underpricing, although it's people could probably guess it, but you think it is the tariff risk. Why?
Tariff risk is really an interesting thing. So typically people say, oh, tariffs, what does that mean? If tariffs come in, they're inflationary, probably for a little while, but really the bigger impact as far as we're concerned is a longer-term effect on growth. Tariffs have a terrible history in terms of reducing growth. So we think if Donald Trump really does push tariffs aggressively, relatively early in his term, you're going to see growth slow globally. Does it mean recession in the U.S.? Maybe not. Does it mean recession elsewhere? It could. And in that case, that could pull yields down. So it's a big factor out there. It's kind of an X at this point, but that could happen.
So you'd be a buyer of bonds because of the tariff risk, instead of being in the camp that they could increase consumer prices, maybe put some upward pressure on inflation?
Well, actually, I would have a very nuanced view. I know it sounds a little bit strange. We'd be buyers only of the relatively short maturity bonds, so 5 years and in. And the problem here is you've got the tariff risk going one way, but against that, there's the chance Republicans actually come together. They all say kumbaya. They pass a bunch of legislation, and they not just extend the current tax rates, but they reduce taxes in some areas. At that point, I think the bond market says, hey, no good. Budget deficit goes up, long-term rates go up. So tariffs, yes, they could eventually drive yields down, but some sort of spendthrift moment in Washington pushes rates going up, and I think it's really not worth taking that risk. So we recommend people stay, to the extent they own bonds, 5 years and in at this point.
Okay, interesting. And Steve Leisman, that kind of answers the question, which is, again, why aren't bond investors or stock investors taking a bigger sigh of relief from, the better PPI data? And like Schumacher said, they're just nervous. Who knows what's about to happen? Trump just announced an external revenue service to literally collect tariffs. If anyone was hoping this would be more talk than action, that announcement wouldn't seem to go in that camp.
Well, I've been pretty consistent about that, Kelly. I think that the president-elect meant what he said when he talked about tariffs, and I think there was a lot of, rose-colored glasses thinking on Wall Street and among his supporters, oh, he didn't mean it. Well, guess what? I think he does mean it, and I think there's going to be tariffs and probably across-the-board tariffs. I think what Michael's talking about is one aspect of why the bond market is unchanged or yields are unchanged. But I think there's maybe two other aspects, and they're a little bit contradictory. I'll go through them as quickly as I can. The first is that the number was good today, but there was stuff in this number that can make you a little nervous about the CPI tomorrow. For example, what's happening with airline fares was one aspect that won't carry over. And then subsequently make you nervous about the PCE number, that it won't be as good. Either the CPI or the PCE won't be as good as we got in the PPI today. Maybe tomorrow we'll dodge another bullet, and we'll see. The second reason that's interesting to me about the lack of movement in the bond market today is something we've talked about, Kelly, which is that it's not necessarily inflation that's bothering the bond market. We've talked a lot about how the TIPS yield spread, which tells us what the bond market's inflation expectation is, it's up, but not nearly as much as the 10-year is up. And so this tells me that maybe the bond market is less worried about inflation, more worried about bigger deficits, and also potentially positioning itself for higher growth in the Trump administration.
Yeah, the only thing about that is the fact that the dollar's been so strong. Normally you'd think, okay, debt and deficit. Look at what's happening in the UK, right? Debt and deficit, a top-level concern. The pound is plunging. Over here, the dollar is soaring. And Michael, you're sort of highlighting that as well. We're already at historic highs. I mean, we've only been higher than we are now on the dollar briefly in late 2022 and in the early 2000s, really going back all the way to the 1980s. So if this move extends itself even more, what's going to be the fallout for the economy and for the markets?
Yeah, it's really interesting, Kelly. When you think about the U.S. dollar, I'd say it's a broad consensus view. Dollar strengthens, and that would normally make us uncomfortable, but we're in that camp. So we can go currency by currency, but there's a great case for the dollar to strengthen versus Chinese currency, the RMB, or against the pound, or against the euro. But as far as what it means for the economy, I think it's sort of a byproduct of a lot of things. So one big reason, perhaps the main reason the U.S. dollar is strengthening, is you've got this positive interest rate differential, which has gotten bigger. So rates are higher here than many other countries. Consequently, the dollar has been gaining and gaining. And also this idea of tariff risk going up, that too benefits the dollar. So those things go together. Now, what it could mean for other countries, pretty big negative in a lot of cases, but in some interesting countries or countries that have large manufacturing bases, they might benefit because you'd say, well, okay, if your currency weakens a lot and tariffs are in play, maybe you don't sell a lot more goods to the U.S., but perhaps to other countries. So I think there's a bit of a buffer there, but it's a very interesting thing, a lot of interconnections there.